welcome back. Now, mining production grew by 9.9% year-on-year in February, this after falling by 3.3% year-on-year in January. The largest positive contributors to this latest print were iron ore, coal and chromium ore. And mining analyst Peter Major joins us to unpack what the increase in output suggests about the sector moving forward. Peter, always a pleasure and good afternoon to you.
Thank you very much. It's a pleasure to be here.
Peter, it's quite a jump, from what the conversation you and I might have had in January to what we're seeing now, almost 10% of a production kick. Let's talk about how you're taking a stock of this number.
Look, I must say, to bore down in some of these results takes a lot more time and work than I've done so far, because to see that iron ore production went up 43%, and we know we produce a lot of iron ore. We produce over 50 million tons of iron ore a year. And if you look at the stripping ratio, we probably move 300, 400 million tons a year just to produce that 50. So when someone reads, hey, the monthly figure shows iron ore production jumped 42%, you have to ask yourself, how is that possible? How did we have more shovels and trucks available to do 42% more? So I don't have all the details, but it's probably coming off a very low month. We had, what do we call it? When you're so full you can't go to the bathroom, constipation. And we had constipation at the railroad sidings. We had constipation at the cargo sidings to load ships. And so then the mine, they'd produced all they could. There's nowhere else to put it. Once they run that down, then all of a sudden they've got room to move. So it's a little bit tricky accounting, but it's good. Iron ore production is up, which means sales are up. Excuse me.
Bless you.
Sorry about that. Okay. So iron ore, that was the big component. It jumped 43%. Coal jumped 15%. And that's also a big number because we produce 250 million tons a year of coal. So it could have been as much because of the rain and the backlog, because we know the railroads cannot move the coal we're producing. The trucks are trying to move it, but it's too bulk of a commodity to be expected to move with trucks. But these are production figures. They're not sales figures. So the mines did produce 15% more coal than they did the month before. But if you seasonally adjust it, say, how about if you look at over a 3-month period, then these jumps are much, much smaller. They're much more smoothed out.
I must also ask you, what we're seeing in terms of the gold there, and from a sales perspective, we are seeing a gold there contributed 25% to what we're seeing with mineral sales there. And of course, we are seeing a decrease in this number, Peter. But what I'm keen to get your thoughts on here is that international demand for gold, even though we're seeing these rather elevated gold prices, what does that tell us about gold as a mineral and really looking ahead at its sustainability?
Look, there's nothing to worry about. Sustainability of gold is always great. We saw those really low prices in the late 1960s, all-time lows, 1,000-year low prices in the 60s. But our costs were very low. We had excellent deposits. Most of our deposits were still a lot shallower than now. So that was a fluke. It didn't last. Then we saw very, very low prices at 30 years later, 1998, 99, 2000. But by then we had a depreciating currency, which protected our mines from that international price. But when we see low prices for minerals, we used to kind of be happy because we knew that would preclude our competitors from building more mines, because we were always the lowest cost producer. We were very much the most efficient producer, and most of all, we were the largest producer by far. Now we're a very small player in gold. What we do in gold makes no difference in the world. We don't even produce 3%. So we're a price taker. We just ride with the flow, and we know the flow of gold's been very good. It's been over $2,000 an ounce now for 4 years. It's now over 2,350 an ounce. But our production, it's very small. We're only producing not even 15% of what we produce for decades and decades. And I see the production numbers on the month. Yes, they were up 25%. But the January month, that's like coming back from Christmas. And that's why a lot of these production figures are up in February, because we know December, January, people are going on leave and they're putting parts of mines on maintenance. Plants are getting maintenance. So if you look at the last 3 months compared to the previous 3 months, our gold production was actually down 2%. And that's more of a understandable number and a realistic number.
I also want to zoom in a little bit on PGMs, Peter, on the back of what you're saying about the role that South Africa might play or might not play with gold, but certainly have a big part to play with PGMs here on a seasonally adjusted basis. PGM production is down, also a negative contributor to sales. But that's actually where the big conversation is being had right now. Are we seeing PGMs turning a corner? And could that lead to better production numbers? And could that lead to better sales?
Charmaine, you've hit the nail right on the head. Yes, PGMs are where we're looking at. They're the largest employer in mining in South Africa. They still employ close to 170,000 men. And I'll give you a real simple rule of thumb here. PGMs account for about 25% of our mineral sales. Coal accounts for about 25% of our mineral sales. So just coal and PGMs, that's 50% of South Africa's mineral sales. So those are the minerals we look at the most. If we go to gold and iron ore, they're almost tied. They are half of that 25%. Gold is about 12.5, 13%. Iron ore is about 12.5, 13. So those two combined are a quarter of this country's mineral sales. So there's 4 minerals that do 75% of our sales. And that's what we have to watch the most. PGMs, next coal, next gold, next iron ore. If government wants to know what to focus on, those are the commodities. They're the ones that employ the most people by far. They're the ones that bring in the most revenue by far.
Well, Peter, that's all we have time for today. Oh, I'm sorry, were you still finishing your thought?
No, that's pretty much
That's
it.
all we have time. Yes, for. Thank you so much, Peter. Always a pleasure having you here. Thank you so much for breaking this data for us and also helping us put it into perspective. I think very important there. That was mining analyst Peter Major.